Well, good afternoon, everyone. My name is Bill Fox. Welcome to our third quarter of Beyond the Noise. Our goal at the Fox Alliance is to offer insight into big economic themes. Our topic for today is Brace for Impact, navigating the 2026 tax overhaul. Today, we'll be discussing a summary of the Tax Cuts and Jobs Act, which provisions are sunsetting, how is the environment different today versus 2017? Tax strategies in a lower tax rate environment. Our panelists will be speaking for about 30 minutes, and we'll have time for questions after that. Just a reminder, because of compliance, our chat feature is not going to be available. So if you do have questions, email me, please, at bill@thefoxalliance.com. Our presenters today will be Max Clark and Laura Cooper, and Laura will be our first presenter today. Laura, take it away.
Awesome. Thank you so much, Bill. All right. So I'm going to get started by talking about what the Tax Cuts and Jobs Act is and some of the provisions that are expected to sunset at the end of 2025. So the Tax Cuts and Jobs Act, or the TCJA, was passed in 2017. It was the first real large piece of legislation passed under the Trump administration, and arguably probably the biggest piece of legislation that was passed. And it was the most far-reaching tax legislation that we've seen in over 30 years. It actually resulted in the lowest ordinary income tax rates that we'd seen in over 100 years in the United States. So pretty significant cuts there. Most of the provisions are sunsetting at the end of 2025. That was written into the bill when it was passed in 2017. So we're going to take a look at provisions on the personal side and corporate side that are and are not sunsetting. So let's start off with the ordinary income brackets. It's a little blurry here. Let's see. There we go. All right. So on the left-hand side here, we have the current tax rates. So the tax rates currently under TCJA. On the right-hand side, we've got the tax rates post-sunset. And basically, the rates are going to go back to what they were in 2017, and the brackets are going to be adjusted for inflation. So the chart here on the right is an estimate, but pretty close to what the brackets are going to look like. This is a lot of numbers, so let me give you an example. Let's say you're a married couple filing jointly, making $350,000 a year. Your highest dollar is taxed at 24%. Now, obviously, not all of your income is taxed at 24%. Our tax brackets are progressive, but the highest dollar that you earn is taxed at 24%. Post TCJA, for a couple making $350,000, your highest dollar will be taxed at 33%, which is a 9% increase on the highest dollar taxed. Again, not a 9% increase across the board, but on your highest tax bracket, which is not insignificant. And we'll look at what that looks like across all the income bands here in a second. Standard deduction and exemptions are also changing. When the TCJA was passed, it eliminated personal dependent exemptions and increased the standard deduction by quite a lot. And that is going to revert. The standard deduction will be decreasing, and personal/dependent exemptions will be returning and increasing. And we'll touch on that here in a couple of slides. I wanted to show this because I think it's really interesting to see exactly how different filers are going to be affected by the increase or decrease in some cases of their tax rates. So let's start here on the left-hand side. We're looking at single filer tax rates for now and then post TCJA. So once the sunsetting occurs, the blue line here represents the current tax rate, and the orange line represents the tax rate post TCJA. So once sunsetting occurs, the orange shaded area represents the income band where tax rates will be higher once sunsetting occurs. But the blue shaded area is the income band where tax rates are actually higher now. So for single filers making between about $190,000 to about $530,000 of income, your rates are actually higher now than they will be post TCJA, which is interesting, especially compared to for joint filers Again, same thing. Blue line shows tax rates now, orange line tax rates post TCJA. Most of this is shaded orange because for most married filing jointly filers, you're going to have higher tax rates post TCJA. There's a very small sliver here, right around $500,000 in income, where rates are actually higher now, and a very, very small sliver where they're going to be the same. All right, as I mentioned, the standard deduction is changing and personal exemptions are returning. So for the top table here, we're looking at single filers, and it's going to be, your exemption is going to be based on the number of dependents that you have. So the standard deduction is decreasing by $6,750, and the personal exemption is starting at $5,050. So if you are a single filer who has no dependents, then you're going to have your standard deduction decrease, but your personal exemption increase, but your effect on their taxable income is still going to be a net increase of $1,700. So you're going to be effectively worse off post TCJA than you are now. That completely changes though as soon as you start adding dependents. So for every dependent added, you receive an additional $5,050 in personal exemption. Unfortunately, I cannot claim my dogs, so I will be in the zero dependents category. But for those of you who do have dependents, you will be able to add them in for that personal exemption, which will offset the loss seen in the standard deduction. For joint filers, it's a similar story. If you have no dependents, then you're going to see a net increase of about $3,300 to your taxable income. But again, as soon as you start to add dependents there, you will have a net decreased taxable income relative to the standard deduction policy of today. All right, a few other miscellaneous deductions here on the personal side. So right now we are currently limited to being able to deduct $10,000 worth of SALT payments or state and local tax payments. That is going away to where now you'll be able to deduct 100% of your SALT payments if the provision is allowed to sunset. That is going to be beneficial for a lot of people who live in high income states, or high tax states, as far as property taxes are concerned. States like California, Oregon, New York, but even states like Texas, where our property taxes are typically higher than, because we have no state income tax. So that could be really beneficial for a lot of our clients. Miscellaneous deductions above 2% of taxpayers' adjusted gross income, or AGI, will now be allowed. And this includes unreimbursed employee expenses and investment management expenses. So virtually the 2% cap of AGI for miscellaneous deductions is being removed. The cap on home mortgage interest deductibility will also be increased from $750,000 up to $1 million. So for those of you who have quite large mortgages on your home, this will be beneficial as well. And lastly, the deductibility of home equity indebtedness will also be restored. So that was removed during TCJA. That will be restored once the provision sunset. Last couple personal provisions here. So estate tax, which I think is going to be one of the biggest areas of concern especially for ultra wealthy individuals. When the TCJA was originally passed, it increased the estate tax, or the lifetime estate exemption, by quite a lot. Right now it's 13.6 million for single, or 27.22 million for couples. And this is a reminder, the way that the estate tax exemption works, if your estate is larger than this limit when you pass away, your heirs have to pay a 40% tax on every dollar above that lifetime exemption. So if you pass away and you're single and your estate is $15 million, your heirs have to pay taxes on that additional 1.4 million above the exemption at 40% tax, which is a lot. But compared to where the estate tax limit is expected to go in post TCJA, it's expected to drop to 7 million for single and 14 million for couples. So in that same example, if a $15 million estate, you now are going to owe taxes on $8 million of that $15 million estate. That is not insignificant. And this is something that I think if not addressed now can become a significant issue, because even if you pass away in 2 years, the difference between today and 2 years can result in a significant amount of taxes for your heirs. So Max is going to talk about some strategies there in a few minutes. Last couple personal provisions here. Under TCJA, the annual tax credit was doubled to 2,000 and phased out at higher income limits. That'll be cut in half, going back to 1,000, and the income thresholds are going to come down. So it's going to phase out earlier. As I mentioned, though, the dependent exemption is being added back, so it's expected to really level itself out. And lastly, when the TCJA was passed, it significantly reduced the number of filers that were subject to alternative minimum tax, or AMT. It's estimated that about 5 million people filed with AMT in 2016. And once TCJA was passed, only 800,000 people had to file under the AMT or under TCJA. So that's expected to switch. And that's pretty significant because if we think about the effect that it has on people's bottom line, from not having to pay alternative minimum tax to now having to pay it could be a shock to the system. All right, finishing out here with the corporate side. So corporate tax rates decreased to 21% under TCJA. They were previously as high as 35%, and the corporate AMT was repealed. Both of these provisions are permanent. This is not sunsetting. It is written into law. It'll take a literal act of Congress for this to be repealed or changed. Which is interesting because the Section 199A deduction for QBI, or qualified business income, that is expected to sunset at the end of 2025. So an argument could be made that this particular section should be extended in tandem with the corporate tax rate. But regardless, as the law is written today, that portion is expected to expire at the end of 2025. So with that, I'm going to turn it over to Max to discuss the likelihood of this happening and also some strategies to take advantage of it.
Thanks, Laura. I appreciate it. Laura obviously just covered with us all of the factors that or aspects of the law that are set to expire come 2025. But I think a question that we should be asking ourselves is, what's the likelihood that this is actually going to occur? I saw just last night that the betting markets have Trump with about a 62% likelihood of winning come November. And if that's the case, we have heard that his platform is suggesting that he will continue tax cuts and potentially even cut tax rates further. That is certainly a possibility, but I think it's important for us to recognize that we really can't predict what the future is going to hold. There's so many factors that could influence that. And I think the safe bet is the path of least resistance. The easiest thing to happen would be to just let this legislation sunset or expire. Because if you think about it, it's not just a matter of Trump winning the election. Congress is required here in order to extend this. And it's up in the air whether or not, even if Trump were to win, despite the fact that he's a favorite, if he were to win, the question would be, is Congress going to lean right as well? Right now, based on the information I've seen, the Senate is leaning maybe slightly Republican, but the House is really a toss-up at this point. So in order to get something like this extended, you're going to need a majority or some sort of bipartisan support, which is possible, for this to be extended. We still think that the most likely outcome is that this tax legislation sunsets. Now, the other thing to take into consideration is that if we wanted to see this made permanent, it's going to require a 2/3 vote, which if it's up in the air whether or not he's going to have a simple majority, the likelihood of getting 2/3 of Congress to support making this permanent seems very low. So even if this were to get extended, it's probably just going to be extended. It wouldn't be made permanent. The other thing to consider here is that we're in a different environment than we were when this was originally passed, specifically thinking about this in regards to public debt and the federal deficit that we see each year. So you can see that back in 2017, here on the left-hand side, total U.S. public debt was sitting at just shy of $20 trillion. And currently, as of the end of 2023, we were at about just shy of 35 trillion. That's about a $15 trillion increase in national debt over the last 6-7 years. That's pretty significant. And we're in a much different scenario now. But I think the more poignant piece of information is the annual deficit that we're incurring as a country. Back in 2017, we were spending about $665 billion more than we were bringing in as a country. That seems bad enough. But if you look in 2020, when the pandemic hit, we actually spent $3.1 trillion more than we were bringing in as a country. And we've tempered that a little bit, but you can see that the trend is downward. As of the end of 23, in fiscal year 2023, our federal deficit was 1.7 trillion. This is a problem that the federal government is really going to need to address. And cutting taxes could potentially help. I mean, we've certainly seen history suggests that at times you bring in more revenue when that occurs. But I think the likely trajectory is that we're going to see tax rates go up over the longer term because the environment now is different than it was in 2017. It's going to be a little bit of a harder sell to get tax cuts passed in this type of environment. Now, all of that to say, even if we do see these tax cuts or this tax legislation extended, it's important to recognize that the strategies we're about to talk about, at least most of them, are not going to hurt you if you were to implement them now, even if the extensions were put into place. Because we believe, based on this information and others, is that over time, tax rates are going to be higher. And taking advantage of the opportunities that we have available to us now makes a lot of sense. So let's take a look at some of those strategies. The first is one that we've talked a lot about with our clients in the past, but it's Roth conversions. Right now, we have the opportunity to take money out of a traditional IRA or traditional retirement plan and convert it over to a Roth IRA, potentially saving us taxes over the long term. Now, for those of you that aren't familiar with that, a traditional IRA or traditional retirement plan, you put money into in the course of your earnings years, and you get a tax deduction for making that contribution. You don't pay taxes on the money you put in to that retirement plan. But when you take it out in retirement or at some point in the future, you do pay income tax on it. Roth is kind of the opposite. The money you put in to that retirement plan or that IRA, you do pay tax on, but it then grows tax-free over time. And when you take it out in retirement, you don't pay any taxes on it. So that sets up an interesting opportunity right now. If you take a look at the right-hand side of the chart, these are the new tax rates that Laura talked about earlier. You can see that the brackets are more narrow on the right-hand side and the tax rates are higher. So if we could do conversions now at lower tax rates, it has the potential to prevent us from paying higher tax rates in the future. Let's just take a look at a simple example. Let's assume we have a married filing jointly couple earning $300,000 a year. They're 50 years old, and we do a conversion of roughly $80,000 to the top of the 24% tax bracket. That means that we're going to pay just shy of $20,000 in tax, 24%, of the $80,000 conversion. But if you look on the right-hand side, as Laura mentioned earlier, the tax rates would be going up from 24% to 33% for that $300,000 income. What that does is it allows us to save a significant amount of tax over time on that money that's in the traditional IRA. Because if you think about it, come age 73 or 75, you're going to be in a position where you have to start taking money out of the IRA. And if you're in that 28 or 33% tax bracket at that point, you're going to be paying taxes at that higher amount. This has the potential to save tax over the next 25 years for this 50-year-old couple of $60,000 to $80,000 over that time period in tax, and leave them with a significantly larger amount of money that's accessible to them in retirement. Now, even if tax rates are exactly the same, the thing to remember here is that you're paying the tax now, and every dollar going forward is growing tax-free. You're not going to have to pay another dollar on that money going forward, or another dollar of tax on those funds going forward. So it saves money for you, and ultimately, if it ends up being passed on to your kids, it saves money for them as well. Now, what about a few other strategies? One of the things that you might want to consider is delaying charitable donations planned for 2025 until 2026. Laura was mentioning earlier that a lot of deductions are coming back into play. And since a standard deduction is being cut in half, we're likely to see a lot more individuals taking advantage of itemizing deductions as opposed to using the standard deduction. And that's important because if you're itemizing deductions, you can take charitable donations into account there with those deductions. So if you were planning on charitable donations in 2025, it might make sense, depending on how all of this plays out, to delay those until 2026. Now, you've got to take into consideration the fact that these charities are likely depending on those gifts. So weigh that in your decision as well. But from a tax standpoint, that might make a lot of sense. Another thing to consider is that as you're buying a house, recognize that property values have gone up, and writing off the property tax used to be capped at $10,000. Laura mentioned earlier that's no longer the case. And so the property tax that you will be incurring for that house that you'll be buying or that you currently own, you're going to be able to offset, or I should say deduct from your income if you are using the itemization as opposed to the standard deduction. The last thing I'll mention here on this slide has to do with ISOs. For those of you that work with companies that grant ISOs, the ISO stands for Incentive Stock Options. Those have a unique tax benefit associated with them. Basically, what an ISO is it gives you the ability or the right to buy a share of company stock at a certain price, generally between now and the next 10 years, at which point they expire. Now, when you exercise that, the ideal situation would be that you buy the share of stock for a price that is lower than the current price, and you get the benefit of that increase. So let's say you buy the company stock at $5 a share and it's currently trading at $10 a share. You get an immediate 100% increase on your ISO or your purchase of that stock. Now, under current law, the way that that works is if you hold it for a set amount of time and ultimately, kind of meet all the requirements, all of that gain is considered capital gain. And because the AMT exemption went away, or at least was, I should say the AMT exemption was increased significantly under TCJA, far fewer people were subject to that. And under the AMT calculation, ISOs don't get that special treatment. So AMT is coming back, the exemption is reducing, and that means more and more people are going to be subject to the AMT calculation. And therefore, it may make sense if you have ISOs to consider exercising them now or between now and the end of next year to avoid potentially being subject to AMT and paying income tax rates on that as opposed to capital gains tax or long-term capital gains tax. Obviously going to be very specific to your individual situation and definitely something you want to consider with your professional advisors. Now let's shift over and take a look at estate tax. Laura mentioned earlier that the estate tax exemptions are being reduced significantly once TCJA sunsets. They're being cut in half. So one of the things that you might want to take into consideration is figuring out a way to get money or to get assets out of your estate and passed on to the next generation so they would not be subject to estate tax. Laura gave a great example of a $15 million estate of a single person. If you can get that money out, you're going to avoid that 40% tax on anything above the exemption. So for a married couple, there are a lot of opportunities out there, and there's a lot of opportunities out there for singles as well. But I want to look at a specific example that maybe a lot of you guys haven't heard of that might be worth considering. It's called a SLAT, a Spousal Lifetime Access Trust. And this is an opportunity where one of the spouses can take a portion of their half of the assets and grant it or gift it to the other spouse in a spousal lifetime access trust. So they put it into the trust, and the other spouse has the ability to access those funds for health, maintenance, education, and support, and get access to them kind of as a last resort or if needed. But then the principal and everything else, whatever's left over, passes on to the beneficiaries. So this is a great way to get money out of the estate, but still give one spouse access to it if needed. Again, it's going to be very specific to each individual situation and certainly isn't right for everybody. But it might be something worth considering. Let's shift down and take a look at corporations. The last suggestion we'll make here is, given the fact that the QBI deduction is sunsetting or is set to sunset at the end of 2025, it may make sense for you, if you have an S Corp or an LLC, to consider another corporate structure, moving to something that's not a pass-through entity like a C corporation. And the reason is because currently, under the law, the tax rate for non-pass-through entities is 21%. But as Laura mentioned earlier, the QBI deduction for pass-through entities like S Corps and LLCs is going away. And as a result, you might end up paying less tax in a different corporate structure. I would encourage you not to make any of those decisions until it becomes very clear that this will sunset. So probably sometime mid to late next year, you make this decision, but it's definitely worth considering because it could save you some significant money in taxes on the income generated from your individual business. So with all of that, I hope what you're seeing from this conversation is that there are a lot of opportunities right now to take advantage of some unique benefits that are available to us in the current tax law, and those are set to go away at the end of 2025. With that in mind, it's imperative, in our opinion, that you at least ask the question, are there things that we can do now to take advantage of these opportunities today? Because it really has the potential to save you and your heirs a significant amount of money in tax over the course of your life and potentially their lives as it passes on to them. So with that, we will open it up for questions. And as Bill mentioned, if you have any questions, please send them on to bill@thefoxalliance.com. Bill?
All right, first question is, does this mean that only amounts for expenses above 2% of AGI are deductible, or that all amounts are due to a cap being removed? Max, would you handle that one?
Yeah, I think we were referencing back to
The miscellaneous deductions.
miscellaneous deductions. In my understanding of that, I can get back to whoever asked that question more specifically. But my understanding is that you can only make deductions if those expenses are over 2%. Or do you know if you can deduct the full amount or if it's just any expense over 2%? I believe it's anything just over 2%.
I believe that's correct, but we'll have to double check.
Okay, we'll get back to you. Next question, how will these tax changes impact consumers' pocketbooks and ultimately the economy as a whole? Laura, please handle that one.
Sure. It's a great question. I think that this is obviously something that's on a lot of people's minds right now, especially considering how impactful inflation has been to a lot of people's pocketbooks. I mean, unless you've lived under a rock, everything's become more expensive. And with the expectation of another expense being added on top of that, I think it could be concerning for a lot of people. We're not exactly sure how this is going to affect individuals as a whole, but what we do know is that when the TCJA was passed, it had a pretty significant effect on the bottom 50% of earners. So this chart shows the effect, the percentage of decrease in taxes paid given different income brackets. And for the bottom 50% of Americans, they saw a 9% decrease in their taxes paid due to the TCJA. So that's not insignificant. I mean, almost 10% decrease. And unless you were in the top 1%, you saw some sort of impactful decrease in your taxes paid post 2017. So it'll be interesting to see, combined with the impact of inflation for a lot of people, how this change potentially affects the pockets of many Americans. We do know that the sunsetting of these provisions, the sunsetting of these provisions is expected to add about $400 billion back to as far as tax revenue back to the United States. So I think that it's definitely something that is not insignificant to consider as we think about the economy as a whole.
Thank you, Laura. Next question. Is the Affordable Care Act, or Obamacare, tax penalty sunsetting as well? Max.
Yeah, that's a great question. And we didn't mention it in this conversation, but I believe what they're referring to there is the penalty that was incurred if you didn't have health insurance during at the time that you filed taxes. And there was a penalty that was put in place or incurred when you filed taxes if you didn't have health insurance in place. That was the penalty was essentially set to zero for or when TCJA was passed, and that is not sunsetting. So that's permanent, and at this point, we should continue to not see those penalties as we move forward.
All right, next question. Will SALT include investment properties like second homes, or just the principal residence? Who would like to take that one?
Great question. I'm not 100% sure. Max, do you know?
I don't know the answer to that. We can do some research on it though and circle back.
Well, luckily we have our tax team available here, so we can speak with our CPAs and get back to you.
All right. Well, those are all the questions that we have for today. Just want to thank our presenters, Max and Laura, and just want to say have a great rest of the week and look forward to seeing you at our next Beyond the Noise webinar.